I'd like to welcome Sean O'Hara to Mirae Asset Securities and the OnTheVine podcast. Thanks for coming in, Sean.
Absolutely, my pleasure, Chris. Always love to be with you.
So Sean runs a company that many of you know well and love, Pacer Financial. Pacer has a growing suite of ETFs. I've happened to know Pacer for quite a bit. Tell us a little bit about what got you here. Where did Pacer come from? I've heard people mention Planko, but maybe people don't know what that is. And so your genetics of a distribution firm and a management firm go back before ETFs, right?
So my partner Joe Thompson, who you know, we've been working together almost 40 years now, and for the bulk of that's on the distribution side. So we ran distribution for the Hartford. After that, we decided we were going to do something on our own and tried to find somebody we could distribute product for. And what we found at the end of the day was it was much better for us to just create our own product and then apply our distribution expertise to it. So we started the ETF company in 2015, about, I guess, 8 or so years ago. Right now, about 28, almost $29 billion in AUM, 47 different products, I think, as of today, growing.
Right? Time out. You started 8 years ago, and you've got nearly $30 billion in AUM?
Yep.
All right. Well, there's a big asterisk right there. I mean, most ETF firms don't grow like that unless you're, converting some asset.
Yeah.
There are a couple of flagship funds that have come to market that might turn to 100, but then they don't grow from that. You started with how much?
0.
Interesting.
So, and distribution is important. We think it's critical. I think that's probably what we do best. I think we're a pretty good manufacturer as well, and I think we've got some really cool strategies. And we reside in the shadow of Vanguard over where we live in Pennsylvania, outside of Philadelphia, Malvern. They're literally our neighbors. So when we decided we were going to start the company, we knew we couldn't be that. So we focused on innovative, disruptive, or unique, things that would be different, that hadn't been done before, but that had an end use in mind. So we always thought about it in the context of, can we solve a problem or can we add to a strategy? Is that strategy viable and worthwhile? And then does it benefit a financial advisor and their customer? And we believe in the financial advisor at Pacer. We don't do much to try to market the product directly in the U.S. because we think that people who work with a financial advisor have better outcomes in retirement and while they're accumulating their assets. So everything we do is different.
But it's funny you went right there because I wanted to I wasn't sure when I was going to get a chance to ask you this, and I had a note to ask you about distribution and about what keeps your sales team motivated. Now, I've had the pleasure of meeting a lot of your salespeople over the years. I've been to some of your sales events, and look, I don't have a huge comp table for what they all look like, but on the inside, the culture of working at Pacer and as a manager, you obviously do something different because your sales force is lethally effective at penetrating the market. And they seem to do it, without even giving a care of what's going on around them. And I feel like when I've met with you and Joe over the years and your team, and we've sat around the table and spitballed ideas and things like that, it's never about what everyone else is doing. It's always, what should we be doing? What should we be thinking about? Does that carry over to your sales team?
Yeah, we don't try to think a lot about, who else is out there. What we try to think about is where we can grow our business and where there's dollars, if you will, that could have a better home, that are significant. We don't want to build $50 million ETFs. We'd rather build $50 billion ETFs. And so with regard to the distribution, we focus on youth, believe it or not. Like, we have a very young sales force. And we like that. And we like that because it doesn't take very long for you to teach somebody everything they need to know about ETFs and our ETFs and the ETF environment, and then point them in the right direction. And so we focus on younger folks to begin with. We focus on folks who come from blue collar families, maybe that are, Division II or Division III athletes, as opposed to Division I athletes who have been pampered their whole life. Nothing against the Division I guys out there, but that's what we like. And so we also have the second side of the distribution thing nailed, right? So you can have a great sales force and a great product, but if you don't have places to sell it, where are you going to go? So we were very lucky early on in being able to build relationships with the wirehouses and the bigger independent broker dealers and the custody firms before things started to tighten up, if you will, because now it's very difficult to get product on platforms. So perhaps if I was going to list what our assets are in terms of what's most valuable to us, I think our shelf space is really valuable. I think our sales force and their ability to distribute product is really valuable. And I think the franchise we've built in terms of the ETFs we've brought out is also like I said, it's innovative, disruptive, or unique.
So let's jump into some of the products. So we can chalk up some of your success to your experience in distribution, some of your success into motivating your sales force. But I think a lot of your success at Pacer is on the backs of good ideas and good product. Most notably the cash cow ETFs. So, for the listener or someone who's curious, what does free cash flow mean? What is cash cows? Like, tell us about the theory behind that. Your biggest product is COWZ.
Correct.
That's 16 billion, 16 billion in AUM. What went into that?
So, if you think about the construction of the stock market today versus what it was 40 years ago, right? 40 years ago, it was very asset heavy, high tangible asset book value companies. Over the last 40 years, we've sort of offshored all of that manufacturing. We've gone through this globalization process. So if you pull apart the value of companies today, it's mostly based on intangible assets. And tangible assets are things you can touch, feel, pick up, put a price tag on. Intangible things you can't see. And so if you're going to try to identify companies that are high quality, that are trading at a discount, that have advantages in this world, free cash flow and free cash flow yield was the very first screen that we looked at. So we apply free cash flow yield, which is the free cash flow a company generates, divided by its enterprise value. And enterprise value is market cap plus debt minus cash. So it's a simple calculation. If we have, like that can over there on the table, if that's a $20 can and it's generating $1 worth of free cash flow, I can divide that $1 by $20. That's a 5% free cash flow yield. If this one over here is a $20 can, but it's giving me $2 worth of free cash flow, that's a 10% free cash flow yield. We think that one's cheaper and of higher quality than that one because I'm getting a higher current return. So we applied this to a whole suite of ETFs. What's fascinating about free cash flow yield is it works across market caps. It works across geography. And what you'll see if you study it like we have is you get the same result no matter what. You get better earnings growth versus your benchmark, in some cases significantly higher. You get a much higher current cash return on your investments. And at the end of the day, you wind up paying a big discount on a PE basis. So we're buying higher quality stocks with faster earnings growth that are paying us more today at a discount to the market.
All right, so I have a lot of questions about the free cash part of it. So the $1, the $2, whatever it is that lives in the free cash flow bucket, is it because they're investing that more? Like, is it because they have it to invest as opposed to one of the predecessor companies that you kind of alluded to, were they living paycheck to paycheck, for lack of a better analogy, and they didn't really have free cash flow, they were fully invested, so the growth opportunity, they were already maxed out.
Yeah, if you think about free cash flow, it's like if you're an individual, your household, right? If you have more money coming in than you have bills going out, you're in good shape.
Yep.
It gives you flexibility to do things. If you have the same amount of money coming in as you have going out, you're surviving. And then if you have obviously less money coming in than is going out, you're in bad shape. The current way to think about free cash flow and what advantages it possesses today is just think about it in the context of small caps today. Our small cap ETF, CALF, little baby cow.
Calf.
Little baby cow. If you look at the S&P 600 or the Russell 2000, which are two of the more common benchmarks, right? And you look at their debt today, right? Because small caps are more highly levered than large caps, generally speaking. They don't get their debt the same way. They don't issue bonds. They go to the bank and get these bank loans. Somewhere around 30% of that index's EBITDA goes directly to debt service. 30%.
As opposed to
5 or 6% for the S&P or 5 or 6% for CAF, because we don't buy the whole index. We screen for the 100 names in those indexes that have the highest free cash flow yield, and they have the excess free cash flow to not have to rely on financing to grow. So when you get excess free cash flow, whether it's large cap or small cap or overseas, there's really only a couple of things that can happen with it, right? You can pay dividends, right? So I like to say free cash flow is the mother's milk of all dividend payments. So we get a little dividend advantage. 2, you can buy back stock. Well, that's always good for an investor, right? You reduce the number of shares outstanding versus the current earnings. That's a good thing. 3 is you can do R&D, or you can invest it in different things. Or 4 is you can buy somebody. So those 4 things are very healthy things, and I would rather own companies that have those 4 common things in common than others. And what we're seeing with regard to that 4th one, you can buy somebody, is there's major acquisitions going on right now in the energy sector. We've been overweight energy for a while, so we've had a couple of names in the portfolio that have actually bought a competitor, like Exxon bought Pioneer recently, is a great example.
Does a rising rate environment or a higher rate environment help free cash flow, companies?
So for compliance purposes, I'll say that I'm not making any predictive statements,
right.
okay? Because Ashley, who you know, would give me a hard time. I would just simply say that if you had two different companies in a rising interest rate environment, and one had an abundance of excess free cash flow and the other didn't, the increase in those interest rates would probably have a lesser effect on the one with an abundance of free cash flow as opposed to the one without a lot of free cash flow. If rates stay high or higher for longer, or if the Fed even figures they have to raise a little more, that's going to have a nasty impact on the company's balance sheets, because we're not fully absorbing all of that yet in terms of, and it's really prevalent in small cap land. Small cap stocks to me are like commercial real estate. Like the commercial real estate market here in the United States is a disaster, right? I mean, you got $1.5 trillion worth of mortgages they're gonna roll. They're gonna roll at eye-popping high interest rates on buildings that are 60% occupied. So the lenders, if they're gonna lend, are gonna make them mark down the buildings. So it's not
Blackstone getting out of the business, or just walking away from some big properties.
Wait, the great financial crisis, you had people, handing the keys to a condominium to the bank. Here, you're going to have, companies just going to hand the keys to a skyscraper and say, "Here, you take it." So, free cash flow is really, really important, especially in a rising interest rate environment, because it gives those companies that have high free cash flow and high free cash flow yield a cushion, if you will, to absorb the higher interest rate costs.
So COWZ, flagship product, what other than cows, which we all, since that's one that a lot of people know, but now what else gets you excited? What are your other products in this category?
Well, so CAF we mentioned, what's happened this year, Chris, is the whole suite has sort of started to accelerate in terms of money in. So COWZ is continuing to gather assets. CAF has been picking up. There's these calls for, we're nearing a recession maybe, and once we move out of the recession, small caps tend to do well, and so we've been under allocated and they're cheap, blah, blah, blah. I think the indexes are not necessarily the right way to play that because of what I talked about earlier, the high debt cost, and 40% of all the small cap names in those indexes don't make money. So we screen out, we don't buy companies that don't make money, and we screen for the stocks with the highest free cash flow yield. So we get a lot of money into CAF. And then, believe it or not, ICOW and GCOW. So globally and internationally, we're seeing big flows. And that's another one of those scenarios where for the last decade or so, I think the average US investor has probably been underweight international. And now it looks exceedingly cheap. And so we're trying to think about reallocating. But when you look at the earnings growth numbers we get on the stocks we own versus the broad indexes, that to me looks like a potentially a better opportunity. If I could buy stocks, for example, in ICOW where the earnings are growing at like almost 30% a year versus the benchmark where they grow at like 6% a year. So if I'm going to go international, again, I think I'm going to be more selective in terms of what I own. I don't think you can just continue to buy cheap beta in small cap today or in international.
That's good stuff. So listen, I did a little, I was poking around the website a little bit. COWZ, COWZ, CALF for CAF, both 5-star Morningstar rated. And GCOW and ICOW are both 4-star Morningstar rated. By the way, all four are the leaders in asset gathering in the free cash flow space, and pioneers, I think.
COWZ for year to date, 1 year and 3 years, number one net new flow in large cap value.
Oh, interesting.
Not just free cash, but like
overall large cap value.
Number one for 1 year, and then for the 3 year number, we're number two, just behind VTV.
Oh wow.
CAF,
your competitor right down the hill.
our neighbor. CAF is number 2 year to date, number 2 1 year, and number 2 3 year in terms of net new flow. Stunning.
It's amazing. But again, I give huge props to the ingenuity, the idea, and your sales force that goes out there and delivers it.
And we got to thank the financial advisors who were willing to listen to a story and bought into the notion that this makes sense in this world, and have continued to use us. I mean, I think we have a pretty loyal base of folks out there across the country who are big fans of cows. Everywhere I go, they go, "Oh, cows! I own cows." So we just want to make sure we thank the financial advisors for coming along with us on this journey as well.
All right, in the interest of time, I want to keep things moving along. I'm going to hit you with a sidebar. There's another fund you have. Maybe people aren't as familiar with this one, TRFK.
Traffic.
It's up 38-40%, something roughly, year to date.
Yeah,
it's having a good run. What's behind this? What is this?
So we launched Server, SRVR,
I remember that.
right?
Yeah.
Data centers and cell phone towers, thinking that we're going to consume more data, right? The data is going to run the world. It's everything we do. I've got a cell phone here. You've got one. We've got tablets. We're in a digital and technological revolution right now, right? And without the data centers and the cell phone towers, that can't happen. So we launched Server as a way to specifically play that from a real estate perspective. Then we thought, well, why don't we take everything in the building and figure out what we should own there? So it's chips, software, you have, connectors, you've got basically the computing parts, if you will.
Like cooling systems are part of that?
Cooling systems
like
are part of that, the whole infrastructure of the building itself. And we sort of got lucky, I guess, if you will, on the performance side, because everybody's talking about AI. Well, when you think about AI can't happen without big computing power, and AI can't happen without the component parts. So I don't know whether anybody's going to figure out how to monetize AI per se, but I do know that there's going to be massive investment in it. And the names we own in traffic are going to be the folks that provide for that to happen.
So let me ask you, and I just, I didn't write this down, but the way you're describing it, and I intimately remember when Server launched, and it made so much sense to me. These tech centers have to live somewhere. There's
Right.
real estate behind it. Made all the sense in the world. Had great success with SRVR, but TRFK on the parts side, with the sort of the horizon looking like a Bitcoin product might be coming to the U.S. market. There seems to be a lot more interest in digital assets and AI. Is that just going to increase the demand for computing power and therefore the equipment that sits in the space? Is it like, are we on the,
I think we're early. I mean, you think about, streaming, you think about the Internet of Things, you think about, e-commerce, right? All of those are sort of technological revolutions, right? I mean, we're not going back to the store, right? When you can just order something, have it there tomorrow.
They order dog food on.
We do too. So when you think about those, now you add to that AI, right? The difference between those other three things and some of the other technological things, as far as this revolution, this digital revolution, if you will, is that AI eats up massively more data. So we're going to shop more online for sure, right? We're going to stream more for sure, right? And so those things are going to continue to grow sort of exponentially. But the addition of AI onto that infrastructure footprint, if you will, is going to put a massive strain, which means that these folks that provide the chips and the software and the computers that are inside these data centers are going to participate in that big wave of being able to provide more data capacity.
All right, last one, Sean, and then I'll let you off the hook, is one that has been near and dear to our hearts. And I thank you for getting our attention to this, but it's QDPL. Not necessarily a genetically unique to Pacer, but you partnered with these guys, for a reason. What did you see in QDPL? Well, first of all, why don't you tell us what QDPL achieves, and what was it that excited Joe and yourself and the team at Pacer to say, you know what, these guys are onto something. Let's strike a deal and let's partner up with these guys, because we've been active in the fund. We see a lot of demand.
It's definitely growing. QDPL is simple. It's two parts. It's part S&P 500 and part dividend payments, and those dividend payments come in the form of dividend futures. So what we do is we simply take the S&P 500 apart. We say how much do we need to invest in stocks versus how much do we need to have in collateral to be able to buy the income stream that we want. That income stream we're trying to buy is 4 times the dividend of the S&P 500, hence QDPL, quadruple. So if the S&P is yielding 2% on dividends, we should be generating 8% in yield in that fund. And it's been live for 2 years now, and it's delivered exactly what it's supposed to. Why do we like it, and where do we think it makes sense? Well, you see covered call strategies. Well, they work great in the down market, but in an up market, if you're writing the calls too close to in the money, every time the stock market goes up, you're getting your stocks taken away. So you don't have any real unbridled upside. QDPL, I know I'm going to have 85% of the upside of the S&P. So if it goes up 20%, I'm going to make 17% on my S&P portion, and then I'm going to get 4 times the dividend. When you think about dividend strategies, right? Most dividend-focused managers buy things like utilities and financials and that kind of stuff that doesn't necessarily grow. Well, why limit yourself? Why not own the broad market in your dividend strategy? And you have a little less risk there because you only are 85% exposed to the S&P 500. And then lastly, when you think about fixed income, I mean, we launched it when interest rates were still zero. They're not, thankfully for today, for the American retiree, they can actually get some yield from their bond portfolio, which is great because they've been suffering for a long time. But at the end of the day, bonds have a finite return, right? You buy it, you get your interest, it matures. you rinse and repeat, right? Well, with QDPL, based on the history of the stock market, over time, you would hope, and history would say, that it'll grow over time. So not only are you getting competitive yield, but you're getting a growing principal base, which traditional fixed income can't give you. So we think it's got a big market and it's starting to get some attention. We think it'll continue to grow.
You know, I hadn't, with the growth of strategies and ETFs coming to market with options overlays on them, you know, it's so much of what we see. Oh, another ETF coming and it's got options, it's got options, it's got options. I never thought to parallel QDPL against that. That actually, that's very helpful.
If you look at, like, take this year, I won't mention the name, it's one of the biggest ETFs, you know who I'm talking about, everybody else does. That fund is fairly large today. If you look at its year-to-date return, it's basically flat to slightly down. When you look at QDPL, if the stock market's up, what, 9% now, or 10%-ish for the year, the S&P 500, we're up 85% of that, so we're up like 8.5%. Plus, we're getting that 4 times the dividend. So,
from a yield perspective, you're getting
people have been using the covered call strategies for a long, long time to generate income. The downside to that is that they're constrained on the upside. And so, what I would say is, if you're a big believer in those covered call strategies, pair QDPL with it, because they sort of mirror each other on the opposite, if you will. The market's going to go up, the covered call strategy is going to lag us. If the market's going to go down, the covered call strategy is a pretty good risk management, tool, and so they work really well together. And so you can unlock some of the potential future gains by adding QDPL to whatever traditional covered call strategy you're using.
Good stuff, Sean. Thanks for coming. All right, I'll sidebar it. You know, you're a Philly guy. You're a Jersey guy, really, but you're
Exit 109.
You know, he's a local guy where I grew up. Jersey.
I was at Shadowbrook over the weekend.
There you go. This is a big, wedding hall, if you will. But Philly now, Eagles. I mean, is it going to happen?
It's a very tough time for me in my household. I lived in Dallas for 20 years, had season tickets for the Cowboys when they won 3 Super Bowls out of 4 years. So I became a Cowboys fan. I married a Philly girl, who you know, yeah. Megan. And so Cowboys Eagles weekend's very tough for me. So just in case, on the odd chance that Megan happens to watch this, I'll say, go Birds, EAGLES.
All right. With that, it's a wrap. Thank you so much, Sean.
All right.